Welcome to the press conference for our New Look Monetary Policy report. On my far right, I have Ben Broadbent, Deputy Governor of Monetary Policy. On my left, Dave Ramsden, Deputy Governor of Markets and Banking. And on my right, the Governor, Mark Carney.
Great. Thank you, Mike. Good afternoon, everyone. At a time when news about the political and economic outlook seems to arrive hourly, it's important to step back sometimes and not lose sight of the big picture. And globally, that big picture has darkened. The world risks slipping into a low-growth, low-inflation rut caused by deep structural forces, limited policy space, and growing concerns about the fracturing of the global trading system. Over the past 18 months, global growth has slowed markedly, business investment has been weak, and trade has contracted. Many of these dynamics occurred first in the United Kingdom, particularly the heavy drag on business investment from entrenched uncertainties over future trading arrangements. Now it's become possible that the picture in the UK could change, with the recent UK-EU withdrawal agreement creating the prospects for a pickup in UK growth. The pace of that recovery will depend critically on the extent to which uncertainty over the future UK-EU trading relationship actually dissipates, and to a much lesser degree by how much the global economy actually picks up. Both are assumed in the MPC's latest projections. Neither is assured. In this context, and with inflationary pressures weak globally and contained domestically, monetary policy will need to be carefully calibrated to support a sustainable recovery. Let me expand a bit on the global outlook. The world economy has moved down from a broad-based expansion to a widespread slowdown, with growth decelerating from around 4% 2 years ago to 2.9% at present. The world economy is now expanding at its slowest pace since the end of 2009. Trade-related uncertainties are clearly weighing on global activity. Global trade has been falling since late 2018. Both the global manufacturing PMI and new export orders remain in contractionary territory, and the global services PMI is now softening as well. Investment growth has fallen, accounting for most of the slowing in GDP growth in both advanced and emerging economies. The headwinds from elevated uncertainty are likely pushing down on the global equilibrium interest rate, exacerbating concerns about limited monetary policy space. In the MPC's latest projections, global growth remains subdued in the near term, consistent with significant protectionism and growing concerns over the reordering of the rules of global commerce. Against those structural headwinds, the recent material easing in monetary policies and financial conditions in most major economies is projected to support a gradual recovery in global growth to around potential rates by the end of the MPC's forecast period. Turning to the UK, the underlying pace of growth has slowed below potential, and the economy is now operating with a small margin of excess supply. Quarterly GDP growth is expected to average just 0.2% this year, about half its pace in recent years. Subdued UK growth partly reflects the weaker external backdrop that I just described, which is weighing on both net trade and investment in this country. But as has been the case for some time, Brexit uncertainties are dominating, weighing particularly hard on business investment, which unusually during an expansion has contracted in 5 of the past 6 quarters and is currently estimated to be just 0.5% higher than at the time of the referendum. Consumer spending has proven more resilient to Brexit uncertainties, growing steadily in recent quarters underpinned by strong employment and a pickup in wage growth. However, there is now evidence of a degree of precautionary behavior, with the latest data revealing that household savings rate has drifted up since the start of 2018. Moreover, uncertainty has weighed on the housing market, and recent data suggests that the labor market could be beginning to soften. Employment growth contracted by 0.2% in the 3 months to August, the weakest outturn since May 2015. The number of vacancies has been falling continuously since the start of the year. The REC demand for staff index is at its lowest level since January 2012, and indicators of pay growth from the agents and the REC have also fallen back. Turning to the withdrawal agreement and its potential implications, the MPC projects that growth is likely to remain a little below potential in the near term, but will pick up thereafter. That upturn in growth is underpinned by a judgment that the Brexit uncertainties facing businesses and households will decline gradually over the forecast period. The MPC's standard practice is to condition its projections on government policy. Accordingly, our November projections are conditioned on an orderly transition to a deep free trade agreement consistent with the aims of the political declaration between the UK and the EU. Although the details of that new trading relationship are still to be determined, the withdrawal agreement and a flexible extension to 31st of January have probably reduced some of the uncertainties facing businesses and households, not least by lowering the perceived risks of no deal significantly. The fall in the perceived likelihood of no-deal Brexit has also led to an appreciation of sterling, which has risen by around 4% over the past 3 months. In our projections, the assumed reduction in Brexit-related uncertainties supports activity. In particular, four-quarter business investment growth picks up materially from current negative rates to around 4.5% by the end of the forecast period. That's the fastest pace since the referendum, and it recoups around 1/3 of the estimated investment shortfall since that vote. Household consumption rises broadly in line with real income growth over the forecast period as a whole, also picking up, in this case from 1% currently to 1.5% in 2020 and 2% by 2022. Demand in the UK is also supported by the gradual recovery in global growth and a boost from UK fiscal policy reflecting the planned increase in spending announced by the Chancellor in his 2019 spending round. Note that these projections are conditioned on the current market path for interest rates, which is consistent with bank rate being below its current level through 2022. The extent of the pickup in UK growth is likely to be limited by continued weakness in growth in the supply capacity of the economy. Potential supply growth is projected to remain subdued relative to historical rates, averaging around 1.25% over the forecast period. That reflects a continuation of the post-crisis trend, as well as the impact of the UK transitioning to its new trading relationship with the EU. Consistent with the provisions of the withdrawal agreement, the MPC's latest projections are now conditioned on the assumption that a greater proportion of the adjustment to the UK's new trading arrangements with the EU take place within the 3-year forecast period, whereas previously the MPC's projections had been conditioned on a stylized assumption of a smooth transition to an average of possible end states, with the adjustment taking place over many years. Overall, the support from lower uncertainty, easier fiscal policy, and stronger external demand has a result that UK growth is projected to pick up from around 1% this year to 1.6% in 2020, 1.8% in 2021, and 2.1% in 2022. So it picks up throughout each year of the forecast. In the committee's projections, excess demand emerges in 2021 and builds over the remainder of the forecast period, reaching a sizable 1.25% of potential by the end. The MPC judges that the risks around its projections for potential supply growth and therefore GDP growth are skewed to the downside in the second and third years of the forecast, reflecting the uncertainty around the exact nature of the FTA with the EU and the transition to it. Turning to inflation, it has been close to target recently. It's expected to decline to around 1.25% by the spring, owing largely to temporary effects of falls in regulated energy and water prices. While unit labor costs have been growing above target consistent rates and core services inflation has begun to increase somewhat, employment growth has slowed and pay growth is likely to fall back in the near term. In the second half of our forecast, however, as a significant margin of excess demand builds, domestic inflationary pressures are expected to build as well. Conditioned on current market yields, CPI inflation is projected to rise to 2% in the second year of our forecast and slightly above that towards the end of it. Let me conclude by turning back to the bigger picture and to policy. For most of the period following the EU referendum, the degree of slack in the UK economy has been falling and global growth had been relatively strong. More recently, Brexit uncertainties and slower global growth have led to the reemergence of a small margin of excess supply in the UK economy. In the MPC's projections, we expect both of these recent trends to reverse. For now, that's an expectation, not a certainty. If global growth fails to stabilize, or if Brexit uncertainties remain entrenched, monetary policy may need to reinforce the expected recovery in UK GDP growth and inflation. Further ahead, provided these risks do not materialize, and the economy recovers broadly in line with the MPC's latest projections, some modest tightening of policy at a gradual pace and to a limited extent may be needed to maintain inflation sustainably at target. At this meeting, the MPC judged that the current stance of monetary policy is appropriate. But however events unfold, it shouldn't come as news that the MPC will set monetary policy consistent with a sustainable return of inflation to its 2% target. And with that, Dave, Ben, and I would be pleased to take your questions.
Okay, usual drill, please give us your name and organisation, wait for the mics, and please one question each first time around. Start in the middle with Joel and then Phil.
Joel Hills from ITV News. Governor, the bank is assuming that the UK will leave the EU with the deal that's been negotiated. You also seem to be assuming that the net effect of that deal on the economy will be slightly negative. Is that right?
The first part is right, the second part is wrong. The first part is that we are conditioning our forecast, as has been our long-standing practice on government policy. Government policy is this deal. It is an agreement between the UK and EU. It's passed the second reading in the House of Parliament. So now that we have a deal, it's conditioned on that. And that's moving from a stylized Brexit assumption to a specific assumption, as you say. But the way to look at the impact of that on the economy is to look at where the economy is today versus where it goes. So the economy growth has been very weak. Recently suffering from weak global growth, but also intense Brexit uncertainties. Economy growing less than an annualized rate of 1%. Our current estimate is that for the year as a whole, growth this year will be about 1%. In every subsequent year in our forecast that we've just released that is conditioned on that deal, growth picks up. So 1.6% next year, 1.8% in 2021, which is the year of a deal. And to above 2%, just above 2% in 2022. Now that growth is helped a bit by fiscal policy, a bit by a stronger world, a world that has stopped weakening and picks up a little bit, but 3/4 of that rise in growth is driven by domestic factors, the most important of which is a reduction in uncertainty driven by a orderly transition to a new Brexit arrangement. Now, I'll finish by just noting that that is an expectation. That's a assumption in the forecast that the impact of the transition will be this reduction in uncertainty and have these knock-on effect, particularly on business investment. And of course, events will see whether that transpires. Deb?
Okay. Phil Aldrich at the Times. Previously, you said that Theresa May's deal would have been marginally better for the UK economically than the bank's central assumption on Brexit. We have now got Boris Johnson's deal, and clearly you state in the monetary policy report that there are aspects of it which will effectively weigh on growth relative to the model that you have been using. So is that not a judgment on government policy then? Is that not a judgment on Boris Johnson's deal, negative relative to Theresa May's deal?
The first thing is that what we have with an actual deal, so we never did a forecast with the previous agreement, what you're describing as previous Prime Minister's deal, because what happened was the agreement was struck with Europe, and then it was voted down in Parliament in the intervening period between it being struck and our forecast. And then, as you'll recall, there were subsequent attempts in Parliament, each time voted down. So we never were in a position where there was a government policy that was fully credible that therefore could be put in. So we don't have an actual comparison of the two. And the second thing, though, is to understand the dynamics of the forecast, which your question kind of goes to the heart of, is that the big shift between what effectively was a stylized representation of an average of Brexit deals at some point in the future with a very smooth, many-year transition to it, to an actual deal that has a clear transition timeline, albeit with some option to extend, is to bring into the forecast horizon some of those transition effects. So customs procedures are put into effect. There's the first impact potentially of some reduction in passporting, gradual building over time, and this doesn't have a big impact, but gradual building over time of potential divergence of product standards. So you get actually some of the transition in the forecast period. And that's the combination of deal. The biggest impact is deal reducing uncertainty, at a minimum taking off uncertainty about the possibility of no deal. So if you remember back in August, where no deal probabilities on various measures were up around a third, in some cases higher, so those probabilities substantially down, so that's a big reduction in uncertainty. Then a path for transition, balanced a bit by some of the adjustments that take place at the latter part of the forecast. What we don't have, last point, sorry, is we only do forecasts out for the forecast period, as you know, Phil. So what we don't do is assessments of the long-term impact of this deal or any other deal.
Okay, Ed and then Jemana, please.
Thank you. Ed Conway from Sky News. Governor, we're at the start of an election campaign. A lot is being talked about extra spending plans, extra borrowing from certainly both of the major parties and some of the other ones as well. Clearly, I know that you'll be wary of intervening in any way in that, but I think, given that you are one of the few institutions out there still forecasting, still giving us your take on how the economy is doing, what would the implications, looking not necessarily at any particular party, of big spending, big borrowing be for the rest of the economy and potentially for what the MPC would have to do?
Yeah. Well, there's always developments in government policy, whether there's an election or just in normal course. We take those as given. We adjust our forecast once policy changes. And one of the advantages, as you know, Ed, of monetary policy is it's much, in many respects, much more nimble than fiscal or other policies, and therefore we can respond with policy accordingly. There's upsides and downside risks in any forecast. One of the upside risks to this forecast would be around future fiscal policy. That's not a comment on any particular platform or program. Again, we would take those into account not as manifestos, but as actual government policy. So, and I'll give the one example, which is notable in here, is that the decisions in the spending round last month adds just under 0.5% to the level of GDP over the forecast. So, that's a set of decisions, actual decisions. It will have a notable effect on the forecast. And following the election, there will be a budget at some point, and then we would take that into account.
Jemana Versace from CNBC. A more near-term question. You've talked about trend growth being roughly half what it was a year ago. You've also talked about less pressure on the CPI front. You've even forecasted CPI to hit around 1.2% in spring of next year. And you've added a line in the MPC minutes saying that monetary policy may need to reinforce expected recovery in UK growth and inflation. Are you gearing households up for a potential interest rate cut in the near future?
Well, the first is that's just what growth is. That's how growth is performing. It is, as you mentioned, and I mentioned at the start, and we mentioned in the report, it is growing at half the rate, on the average rate of the previous 3 years, around 0.2%. Secondly, the biggest driver of the move in inflation are temporary factors. Petrol prices are down a bit. Sterling's up a bit, so you get some pass-through from that. But then most importantly, regulated water and energy prices, decisions that have been taken by Ofgem or Ofwat and Ofgem, respectively, are going to move those inflation down to around 1.25% by the spring. We would look through particularly the last of those, as you would expect. The point about potentially reinforcing the recovery is that in the event that some of the downside risks to the forecast materialize, given the starting point of the economy, that it's in a position of, in the judgment of the committee, some excess supply, so it's not operating at full potential, and given where inflation is, underlying inflation, not those temporary moves, that if we didn't see the expected reduction in uncertainty and therefore the pickup in activity, or if, importantly, the global economy weren't to stabilize, as we are projecting that it will, but if those weren't to happen, then there may be a need to provide some reinforcement. But that's not pre-committing to anything. It's observing the balance of risks on the forecast.
Okay, David over here, and we'll come to Larry, and then I'll come back over here to you guys.
David Smith, Sunday Times. Governor, it looks very much from your projections, particularly for business investment, that you are assuming that what you describe as a deep free trade agreement will be concluded by the end of 2020. And pretty well every trade expert says it will be impossible to conclude a deep free trade agreement in that time. Is that your assumption, and do you think it's realistic?
So there's a few flexibilities here, as you know, David, which one is that there's the core timeline for concluding this arrangement, which is exactly as you just stated, by the end of next year. There is a provision under the withdrawal agreement that negotiating period could be extended by up to 2 years. That's a mutual decision that, as you know, has to be taken by the middle of next year. And there are a range of potential, well, there are certain things in the agreement that have been agreed up front. Very importantly, no tariffs, no fees, no other costs. That is agreed up front in the combination of withdrawal agreement and the political declaration between the two sides. So some of the basics, very important basics, have been agreed there. And there, I will note that one trade expert, Pascal Lamy, former Director General of the WTO, has observed that this is a very different situation given the starting point, particularly on good standards and other aspects, and the degree of integration. He's making that point in a positive sense in terms of potential execution of an agreement. All that said, the thrust of your question is, could it potentially take longer? Yes, that's possible. There's flexibility in the agreement that it could take longer. And is it possible that there would be some implementation period for the agreement? Yes, that's possible. Most trade agreements have, for some sectors, some degree of implementation that takes place. So what we have done, which is a simplifying assumption and is not based on any knowledge of how this could actually transpire, is to assume that there is an orderly transition over the time horizon, that customs checks come into effect, that some other impacts of that trading relationship that are likely to happen come into effect, such as some reduction in passporting and financial services, which has an impact, some other services activity, such as legal services, which can have an impact, and then that there's gradual divergence, most of which will happen beyond the forecast horizon in terms of product standards and other standards, which is to be expected because it's not overnight that either side would instantly change those types of rules. So they are simplifying assumptions. I'd have to say that what you can reasonably expect is that in subsequent reports, as more information becomes clearer about what's being negotiated, what's on the table, and the timelines around both completing those negotiations and any implementation, there will be adjustments that could have an impact on the outer years of the forecast here. So we've done our best given what we know. And I'll finish with this because this is what brings it back to activity over the course of the next few years is that the extent to which the broad expectation of an orderly transition to some deep free trade agreement is the expectation of businesses and households, then we expect these types of dynamics in the economy. But if that is in doubt, or becomes in doubt for whatever reason, or there's fairly profound uncertainties about the end results or timing exactly of either the nature of the agreement or the transition to it, of course that will be pulled forward into activity, and we will see less of a reduction in entrenched uncertainty. And to go back to the first question, in terms, we'll see less of a pickup in the economy in subsequent years, and then that loops back to the predecessor question, which is around what are the implications if there isn't that dissipation of the entrenched uncertainty for monetary policy. Okay.
Larry Elliott of The Guardian. Governor, the sad day of your departure is rapidly approaching, and the government has yet to appoint someone to be your successor, perhaps because it's having trouble finding anybody as illustrious. But I wondered whether you've been asked whether you would be prepared to stay on after the 31st of January, and if you have been, if not, would you be prepared if the government came to you at some point between now and then and said, there's so much going on, Brexit Day is approaching, and elections just happened, would you be prepared to stay on if you were asked to do so?
Well, you almost said all that with a straight face, Larry, at the start. Look, the commitment that I've made has been for a smooth, orderly transition, both in terms of around no-deal Brexit risk, and that has been the work principally of the Financial Policy Committee and the PRA to get the financial system ready for any form of Brexit. And then the second element of that transition has been an orderly transition to my successor. I'm committed to do what's necessary in both cases to make sure that the handoffs are appropriate. Look, I think it's entirely understandable that given the priority, the overwhelming priority of the Brexit negotiations and then the political process that is underway, that a decision has not been made about my successor. And then on the other side of the election, I'm sure the government, whoever's in the government, will take that decision in an orderly fashion. But we'll make sure that the transition is smooth and orderly, just like our assumption in our NPR forecast. Although I must say the transition to my successor is not relevant to the forecast. Thank you.
Okay.
Yeah.
Jill, just behind you, and then Russ. Thank you.
Jill Ward, Bloomberg News. Another question on the assumption. I note that you're describing it as an orderly transition now,
Yeah.
not smooth, like in the previous assumption. What is the reasoning for that change?
Yeah, it's it's as much to make the distinction between the two, by which I mean that, or what the committee means is that we had this smooth assumption, which, as we've said, was based over many years. So it was a gradual shift from the current relationship to some average over a period, longer than a decade, to be candid. So you just have it gradually fading into the forecast. That became increasingly untenable as an assumption, as you know. By the time we got to August, you had two factors. One, we're getting closer and closer to an actual Brexit date, so there was going to be some adjustment. And then, of course, in August, there was also substantial weight in financial markets and business thinking that there might be no deal, there might be a no-deal Brexit. So to make a distinction, we've changed the adjective to, from smooth to orderly. But we are assuming that it will be clear what the destination is, and there'll be, as we say, and as I said to David Smith, there'll be an orderly transition to the new trading relationships after the date at which they begin to take effect. Because there's a distinction here, as you know, which is there's a distinction between Brexit, which currently scheduled by 31st of January, if not sooner, and the point at which those new trading relationships take effect. And once the first has happened, that's kind of irrevocable, and the second is the is a more commercial adjustment to those relationships.
From the Telegraph. Just on your 2021 forecasts, the Q4 ones, in August the adjusted ones were 2.2 and they're down to 1.8 today. I just wondered if you could just unpack that a little. Is that the sort of crystallisation of Brexit risks, transition risks on growth?
Yeah. Why don't I start, and then I'll hand to Ben to expand a bit. But the punchline in terms of the biggest difference between the August forecasts and the current ones is that the world is weaker and asset prices have changed. Most notably, UK financial conditions have tightened, largely because sterling has appreciated as the last response to Jill Ward, which is just the taking out of the no-deal Brexit risks, largely by financial markets. There's very low weight on it at present in financial markets. So both of those weigh on UK activity. And actually that accounts for, if you look across that period, the forecast period accounts for 3/4 of the difference between the two. And then what's left as a residual, I mean, it's notable, but as a residual is the combination of fiscal policy and then this transition. But Ben can...
Yeah, over the period, over the forecast as a whole, most of the reduction relative to this adjusted August forecast is the world. And that affects us both directly in terms of export demand, but also investment. So investment has been weak, we think, largely over the last 3 or 4 years as a whole because of Brexit uncertainty, but also more recently because of weakness in world growth and tradable production, manufacturing in particular. And that's the principal reason, taking the forecast as a whole and the reduction in the level of GDP by the end of it. That's the main reason why it's lower. The Governor a moment ago referred to this difference between smooth and orderly and a sort of more realistic, I should say, assumption about the time over which some of these transition effects come through, and that does play a part in the 2021 forecast in particular.
Sue here, and then Adam's back at the end.
Sue Chan, BBC News. Just following on from Ed's question, I know we wouldn't expect you to comment on potential government policy, but given that the Bank of England, like many other central banks around the world, have been doing a lot of the heavy lifting in terms of supporting the economy since the crisis, is more government spending welcome in terms of perhaps giving you guys more room, doing less of that heavy lifting, and also in terms of boosting productivity and long-term growth?
Well, you're exactly right. I'm not going to weigh into the election commitments of any of the parties. I will note that, and it is picked up in the report, that if you look across the G7, and I'll refer you to page 17, that there has been an easing of fiscal policy across advanced economies as a whole. It's notable, it's material, it's part of the global forecast dynamics. I'm sorry, Sue, I'm just going to repeat, which is what you know, which is that fiscal policy and structural policy for governments, we take those as given, and then we will react to them as appropriate. Thanks.
Adam Linton, Ranscorp. So just in case we go through January 31st and a deal is not passed through Parliament, one of the key phrases in your minutes release is entrenched uncertainty. How would you categorise that at that point, and what would your threshold be? Would you potentially take an approach such as the Fed and deliver insurance rate cuts in a more proactive stance, or would you potentially be more reactive to the data, and what exactly would you be looking for in the data?
So what matters, it's a fair question, what matters is what businesses and households in the economy think. That's and obviously within the context of how financial market prices changes. So uncertainty is in the eye of the beholder. That has the impact on the economy, and we will need, in that circumstance, would need to make the judgment about whether to lean against that uncertainty to taking all factors into account in order to return inflation sustainably to target. Of course, what you're asking is a deep, hypothetical and to some extent a tail risk. But what we've laid out is a framework in terms of our thinking and what we're watching. Let me just be clear, though, there's a variety of ways to measure uncertainty, and none of them are perfect, and so you have to look at them to some extent in the round. Uncertainty measures in financial markets have a decent correlation. You may want to expand on this. Decent correlation with some underlying business activity. We have survey measures, a variety of survey measures that we produce, the DMP being one of the most useful because of the scale of its coverage, also directly from our agents, as well as PMI and other indicators, which the PMIs have turned out to be less good about short-term nowcasting or forecasting, but again, taken in a sort of mosaic approach, are useful in terms of understanding levels of uncertainty. And then very importantly on the household side, looking on consumer confidence measures, particularly around personal job prospects, because that's where you start to see the behavior shift in terms of activity. But do you want to expand a bit?
Yeah, I mean, let me just say a couple of things. The Governor referred to various measures of uncertainty. We use quite a few. One is prices of options in financial markets, options around currency risk in particular, and that seems to correlate quite well with business investment. And that has come down. It's still elevated relative to other advanced economy currencies, but it has definitely come down. The other thing I'd say is that what we think mattered a lot, in particular over the last couple of years, was the fear of very bad outcomes, of no-deal outcomes in particular, and that has definitely retreated. So we will watch all these measures, including their effects on investment intentions in other surveys, quite closely. I think it's a reasonable expectation that uncertainty should ebb away given the reduction in that no-deal risk. Yeah. But as the Governor said right at the start, it's not an assured thing. It's a reasonable expectation, but we will have to wait and see.
Yeah, just to re-emphasize that last point, which is that, and that's part of what we're, with the new monetary policy report, which you're enjoying, beautiful report. There's a whole chapter on exactly these dynamics, because it's one of the key ones that's driving it, and one of the points that Ben just made, which is that it's, short-term cliff edge type uncertainty, which is has a particularly, goes to your question, large effect on economic activity. That's what we've been seeing.
Okay, Matej just behind you, and then Jason.
Thank you. Matej Ruska from Politico. Could you please quantify or explain the cost to the economy of not ratifying the deal in October, if there was any cost? Thank you.
What we expect in the third quarter is that, our current estimate, as detailed in the report, is actually up a bit from our August estimate. So we think growth around 0.4 on a quarterly basis in the third quarter, and then straddling into October. We have it 0.2 is the estimate in this report, which I would note is substantially higher than the various survey measures of growth. That's detailed in the report, but we think that partly because of the agent expectations, partly because of other information, we do think that growth is still running at a positive trend at the moment. I'm on sounder territory. That's the short-term nowcast. I could just stop there, but then I'll just refer as well to say that what the core of the forecast is what happens if this deal continues its process of being implemented. Obviously, it has to be ratified, but then implemented, which is that pickup in growth throughout the forecast. And for example, I gave you the headline numbers on growth, but in business investment growth by the spring of next year is turning positive in our forecast. That's consistent with the underlying. And then accelerating from there, and we start to see the payback from that.
Jason Douglas from the Wall Street Journal. You've talked a lot about slowing global growth. Can I just ask you directly what weight you'd attach to the risk of a global recession?
Yeah, it's a tough question to answer in the sense of there are an unusually large range of definitions of what is a global recession. So if you take just the simple answer is to say, well, if we're looking for 2 quarters of negative growth, that's happened once in the past 35 years. We've both lived through it in just the immediate aftermath of the most intense phase of the global financial crisis. So it's exceedingly rare, and we're at 2.9%, even with intensification of trade tensions. We don't see that on the prospect. The IMF uses a definition in terms of per capita GDP growth, which getting that down into that being negative, that's, again, we're a long way from that. Quite often thresholds, though, are used in terms of 2.5% or 3% PPP-weighted growth, and we're not that far away from 2.5. I wouldn't use 3. 3 used to work as the old shorthand when the globe was growing at 4.5%, 5% pre-crisis as a sort of average. Now that the trend rate of growth, we think trend global growth is somewhere around 3.5%. So we're well below that trend, dipping down to 2.5%. And this is where you move from what is a recession defined to what feels like one. And certainly, if there were another leg down in global growth, we will feel that effect. And we are feeling. I mean, the UK is one of the most open economies in the world, and we have been feeling the effect of that global slowdown. It has been clouded somewhat by even bigger effects of domestic developments, both positively and negatively. And I'll make a final point on the global situation, which is there are 2 factors which sometimes get underweighed. One is that one is easy to see, but gets maybe less weight than it should, which is that the expansion is increasingly reliant on household spending, and normally that doesn't persist for that long without the other drivers of growth. It's hard to drive on one engine. And then secondly, and this is a more esoteric point, but it's relevant, it's hard to measure, but relevant, is that the uncertainties around the nature of the system, global trading system and other things, is yet another factor that arguably is pulling down on global equilibrium interest rates, which constrain monetary policy space, all things being equal. Yeah.
Okay, Rahul there, and Hans behind, yep.
Rahul Karunakar from Reuters. Based on the surprise vote today, would you say the BOE is leaning towards a rate cut next rather than a hike at this point?
Well, what's relevant is it's all relevant, but the mass of the committee's view is that the current stance of policy is appropriate. The forecast is consistent. If the economy follows a trajectory broadly consistent with the forecast, this drop in uncertainty, stabilization of global growth, pick up from there. Some modest withdrawal of stimulus at limited extent and a gradual pace would be appropriate. But we'll have to see. These are pretty big tectonic forces operating right now. Where is the global economy turning, and what is the impact going to be, or what is the trajectory going to be in terms of the implementation of the agreed deal between the UK and the EU?
Hello, Hans van Leeuwen from the Australian Financial Review. In the sort of back part of the report, there's a bit about the global trade, and you say protectionism could be pervasive and persistent, and quote a Bank of America Merrill Lynch report saying that the US-China trade friction could be the new normal. Is that something that you endorse?
Well, it's something that, let me put it into our own words, which is that, and what I said at the start, which is that there are growing concerns about the reordering of the rules of global commerce, so that those are where tariffs are, and it's detailed in the report, the sharp increase in number of protectionist measures relative to liberalizing measures. That's been going on for about 2 years now. So there's tariffs, but it's also around questions that are beginning to develop around technology, technology stacks, whether certain supply chains are sustainable, given a variety of concerns that have come into place there. So whether it's concentrated between the two largest economies or it's a more generalized point, I think we hesitate to use the term endorse, but we recognize that all forms of protectionism are becoming more pervasive, persistent, and more damaging, certainly than had been expected a few years ago. We had been flagging for a while that we felt that, given what we had seen in the UK in terms of the knock-on indirect effects on business investment, that could be happening, could happen globally, and unfortunately, that appears to be what we're seeing.
Pass the measure there, please, and then Delphine.
Naira Chehich, Bloomberg TV and Radio. Governor, although you've taken great pains to lay out the balance of risks both to the upside and the downside, I suspect there may be some in the market who will see the risks more skewed to the downside and start pricing for the next move even more to be a cut rather than a hold from here. How high would you say the bar is to policy easing from the Bank of England, with 10 being extremely high and 0 being not high at all?
That's so clearly not going to answer that question. Let's go back. Let's look at the two components of it. One is, the two biggest things, and quite naturally the thrust of the questions have been around the Brexit deal and uncertainty and where it could go, and the world. And to go back to Jason's question about probability of recession, when we look at the global economy, we don't see the types of fundamental imbalances that are normally associated with the economy tipping into recession. So in Dave's world and financial markets, yes, there's pockets of leverage and things to manage, but there is not, as a whole, in the major economies, corporates aren't over-levered. Households in the major economies, certainly the UK, the US, others have worked hard and paid down debt, so they've reduced leverage. Inflationary pressures are well contained. And so there's not the usual, as I say, imbalances that normally precede a recession. What there is this growing concerns about the nature of the system and the knock-on effect on business confidence, and eventually, over time, that can entrench a slowdown without the investment, without the productivity, therefore the wage growth, therefore, et cetera, and just reducing the global level of supply. Now, we think that given the scale of monetary stimulus and improvement in financial conditions has happened over the course of the last year, and it's very hard to make a call on trade policy. In fact, one's almost guaranteed these days, if you have a monetary policy press conference, that some major trade event will happen either positively or negatively right after that. So maybe we're due for a major positive trade announcement. We can hope for that. But if we don't get a material change, so there stops a deterioration in trade policy, if I can put it that way, the forces are there on balance that we think the world will stabilize and pick up a bit. And domestically, others can make their judgments about what they think are the probabilities of the deal being put in place and implemented in an orderly fashion. We have made our judgment on that, which is an objective judgment given that it's government policy and how it would affect the economy in our judgment, provided it is implemented in an orderly way. You put those together and then you can, again, as the economy unfolds, make a judgment about the likely stance of policy. So.
Thanks. Mr. Carney, as you say, fiscal policy is, at least at the moment, entirely a matter for politicians, and manifesto commitments stay in that territory. But if Labour were to win a majority, they've made it clear that they would see some role for the Bank of England on the fiscal front in providing credit guidance and perhaps on productivity. Is that a role you'd welcome, and do you see any scope for redrawing the boundaries?
Well, the system here, as you know, Delphine, is our responsibilities are governed by statute. In fact, right down to the level of why we have to have a press conference today is under statute. We have to make these decisions every 10 weeks, and it falls into this timeline. But at a higher level, the objectives of the bank are set out in statute, and then the remits and the structure of our committees set out in statute, and then the remits or the interpretations consistent, or the prioritization maybe is the best way to put it, consistent with the statute, is made by the government of the day in a public remit letter, which we're then charged to follow. So it's not for us to determine what Parliament passes, how the government of the day prioritize consistent with that statute. This is what operational independence is you're given a task, and then you, as best as you can, manage towards that task. You should be given tools in order to also achieve that task as well. But
conscious that a few of you haven't asked questions. Is there anyone who hasn't asked a question and wants to, or should we loop back to it? Okay, Kevin, yeah.
Kevin Trublet for Agence France Presse. If uncertainty continues and if a rate cut is needed before the Brexit is done, will the Bank of England have still enough ammunition to deal with a disorderly Brexit or with a prolonged uncertainty? Thank you.
Well, I think the second part is not in our forecast. It's not our expectation. In terms of the preparations that the Bank of England has been making, have been concentrated on the financial sector and making sure that it's ready for whatever form Brexit could take, including what is now a less likely scenario, a tail risk scenario very much, a no-deal Brexit. And the system is ready for that. The core of the system is ready for that, and it will remain ready for that. We'll ensure that. In terms of ammunition, so to speak, the bank has, the MPC has, in terms of monetary ammunition, it has considerable, again, to use your term, it has considerable policy flexibility, but also ammunition, if you want to term it that way. But it would be guided by the inflation target, achieving the inflation target. And last thing, I should reinforce that, again, in that scenario, as in all Brexit scenarios, we're governed by what the form of Brexit means for the exchange rate, for supply and demand in the economy, and the sum of that.
Okay. In which case, final trio from Ed, Joel, Phil. Race.
Front row. There you go. All right. Look, you mind.
Apologies if I'm being dense here. I know that we've kind of gone over this territory a couple of times, but
let's do one. Let's do one. That'd be good.
But this is the first time the bank has actually, looked at a specific deal in its forecast round. So you're in a better position now to know what this means for UK economic growth than ever previously in this process. So is the economy going to be growing faster under this deal than had we not voted to leave, or not?
It's not the question that the MPC needs to answer. What the question the MPC needs to answer in order to do our job is, where's the economy today? Where do we think the economy is going? And of course, the deal, how it's implemented or whether it's implemented, transition to it, is relevant for how the economy is going to perform over the next 3 years. But we don't have the remit for it, the mandate for it, or the luxury of comparing that to some other parallel situation or alternative situation of a different deal. Well, yes and no. I mean, we have one forecast which we agree as a committee, and once we have a forecast, then we publish that forecast as the central expectation of the committee, which is published in the Monetary Policy Report. There are governments, Treasury and others can do forecasts on longer-term implications of various arrangements. Joel.
I'm going to have another go too.
Okay.
Look, because people at home will sort of want to get some sort of clarity on this. The Bank of England is assuming that Brexit will happen. The outcome of the election is highly uncertain. What will happen to these growth forecasts if the UK ends up staying in the EU?
They'll change. I mean, they will change. And they'll change based, the forecast is, and I'm not being glib, like, obviously they will change if there's a fundamental difference in terms of the path that the country takes. We're not going to be drawn on in which direction or by how much. No. It's not for us to say. I mean, what we have, I think it's important, in setting monetary policy, whether it's about fiscal stance of the government or what happens in the global economy, is we have to take things as they are, make judgments about where they're going in the most likely scenario, and then set policy on a forward-looking basis accordingly. And in something as fundamental as this, it's what is government policy? This is government policy. Consistent with this and a few other factors, we see the economy picking up each year over the course of the next 3 years. And ultimately, inflationary pressures building, not immediately because various factors we've talked about this afternoon, but building over time, and then policy adjusting accordingly. Phil has the microphone.
And finally,
sticking to Brexit. On July the 1st, we have a deadline for extending the transition period.
Yeah.
Under the forecast that you've currently produced, if we get to January the 1st and we have not triggered that extension, will Brexit uncertainties rise relative to your current set of forecasts?
We'll have to see how businesses respond. I mean, one of the things, Phil, is that the nature of the surveys and other information, we have some information that is based on conversations post the actual agreement of a deal, not just the meeting between the Prime Minister and the Taoiseach, but after the agreement of the deal, but not much. And so it's only in subsequent surveys we'll get a better sense of how uncertainty evolves. So we'll have to see and then adjust accordingly. It is the case, and it will depend, of course, importantly, on how much progress is made in subsequent months on specifying the deep free trade agreement that is the intention of the two sides. It is the case, as detailed in the report, that approaching, uncertainty can rise as we approach these key decision points in the Brexit process, and that can have an impact on activity, but we'll have to see.
okay, we're out of time. Thank you all for coming.